Hello and welcome to Financial Intelligence. In this video, I want to talk about investment strategies against inflation. Because of excessive money printing after the pandemic, many people believe that the inflation rate in the United States is going to pick up. I'm going to introduce 4 classes of investments that are normally used to hedge against inflation. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you don't miss any of my future videos. A disclaimer before we get started. Note that I'm not a financial advisor and opinions expressed in this video are based on my research. For professional advice, you should talk to your financial advisor. This video consists of 3 segments. First, I'm going to quickly talk about inflation. Then I'm going to share with you the general idea of how you can hedge your portfolio against inflation. In the third part, I am going to share the 4 common asset classes that you should consider using as a hedge against inflation. Part 1, inflation. Inflation is defined as the decline in the purchasing power of the currency over time. In other words, in an inflationary environment, the purchasing power of the money that you have today is going to be lower next year. This usually happens when the money supply, in other words, the amount of currency available to people, is increased without a corresponding increase in the volume of products and services available for purchase. This is very much similar to what has been happening in the United States. The government has been printing money and increasing the money supply, which is going to result in inflation. This chart shows you the Consumer Price Index, or CPI for short, posted on the US Bureau of Labor Statistics website. The Consumer Price Index measures the average change in prices over time that consumers pay for baskets of goods and services. As you can see, the CPI index has gone up by 4.2% in the last 12 months. I will add the link in the description box below so that you can check it out for yourself. Part 2, protection against inflation. The ideal investments for hedging against inflation include those that maintain their value during inflation or that increase in value over that period of time. We know that inflation increases the cost of products and services. Any investment that stands to benefit from these price jumps or is resilient to price hikes is considered as a good hedge against inflation. With any diversified portfolio, keeping inflation hedged asset classes on your watch list is critical. Gradually investing in these types of assets over time can help your portfolio thrive when inflation hits. Common anti-inflation assets include TIPS, various real estate investments, commodities, and precious metals. Let's take a look at each of these asset classes in more detail. Part 3, asset classes to hedge against inflation. Number 1, Treasury inflation protected securities. Treasury inflation protected securities, or TIPS for short, are the most straightforward way to protect against the potential increase in inflation. What are Treasury securities? Treasury bonds are debt securities issued by the United States Department of the Treasury to help pay for the US government's borrowing needs. In other words, investing in US Treasury bonds is analogous to lending money to the US government. This is how Treasury bonds work. As shown in this picture, first you lend money to the government. Second, the government pays you interest rate in the form of biannual coupons. And third, after the end of the lending period, the government gives you back your principal. The government gets to use your money during that period and compensates you by paying interest every 6 months. Regular treasury bonds have fixed coupon payments. Therefore, the amount of interest rate that you receive will not change over time even when inflation goes up. This is where tips come into play. The coupon payments of tips are tied to changes in inflation. So in inflationary periods, tips pay out more interest. As a result, they are the most direct hedge against inflation among the options discussed here. These securities are ideal instruments for people looking for some inflation insulation. Number 2, real estate securities. Another type of asset class that provides protection against inflation is real estate. Property prices and rental income tend to rise when inflation rises. That is because inflation increases the construction costs, and builders of homes generally shift higher construction costs onto buyers. Therefore, one way of protecting your portfolio against inflation is to invest in real estate. You do not have to necessarily buy a rental property to participate in this market. Mutual funds or ETFs that provide broad exposure to national and international commercial and residential real estate markets are good options to consider. Another great alternative is to invest in real estate investment trusts, or REITs for sure, which are companies that own and operate income-producing real estate. A REIT consists of a pool of real estate that pays out dividends to its investors. Investing in REITs gives you exposure to real estate without you having to purchase or manage a property. Number 3, commodities. Commodities are produced or extracted products, often natural resources or agricultural goods, that are often used as inputs into other processes. Investors break down commodities into 2 categories, hard and soft. Hard commodities require mining or drilling to find, such as metals like copper and aluminum, and energy products like crude oil, natural gas, or unleaded gasoline. Soft commodities refer to things that are grown or ranched, such as corn, wheat, soybeans, and cattle. Because commodity prices typically rise when inflation is accelerating, they offer protection from the effects of inflation. Few assets benefit from rising inflation, particularly unexpected inflation, but commodities usually do. To hedge your portfolio against inflation, you do not need to necessarily buy these commodities and store them. You can simply get exposure to these commodities through exchange-traded funds, or ETFs for short, and mutual funds. For example, you can buy ETFs that specialize in commodities or buy shares of stock in companies that produce commodities. Number 4, precious metals. Precious metals are thought to be a good portfolio diversifier and hedge against inflation. That is because precious metals have limited supply and as a result cannot be devalued when the government prints money and increases the money supply. Note that gold, perhaps the most well-known such metal, is not the only one out there for investors. Silver, platinum, and palladium are all commodities that can be added to your precious metals portfolio, and each has its own unique risks and opportunities. Note that the performance of precious metals under inflationary situations has not been super consistent despite what their proponents want you to believe. Therefore, as an inflation hedge, precious metals are my least favorite of the 4 types of assets that I discussed in this video. I have included them here just for the sake of completeness. I hope that you like this video. If you have any recommendations or suggestions, please add them in the comment section below. Don't forget to subscribe to this channel and like this video, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.